Hey everyone, it's Ben Hardy here, and in today's video, we're going to be talking about when the car market will bottom out because we have a bunch of updated information that gives us a much better idea of when this will actually happen. Before we get into this video though, as always, if you want to save time and money the next time you purchase a car, link to my car buying guide in the description down below. And if you want to see more videos just like this, then I recommend you subscribe because I post this content every single day. Let's get into it. We first have to talk about everything that is currently causing the car market to decline, and once all of these things stop happening, then that means that the market's going to stop declining. So let's discuss these items one by one. The first item that's causing the car market to decline is interest rates, and this is what everyone is talking about. Over the last year, interest rates have increased by a massive amount. At the beginning of the year, you could very easily get an auto loan rate of under 3%. And now it's difficult to get an auto loan rate of under like 7%. And so as long as these rates stay high and continue to increase, car values will continue to decrease on the used market. Now, in terms of when these rate increases are going to stop, well, it's just a guessing game at this point. Financial analysts think that, by the end of 2023, we'll stop seeing rate hikes, and then sometime in 2024, 2025, we'll start to see interest rates actually come down. But it ultimately is just a guessing game. Anyone saying that they know the answer doesn't really know the answer, especially when your guess is farther out into the future, because the farther you guess out into the future, the less likely you are to actually be correct with what you are guessing. And so we just have to wait for that to happen. But what we recently saw with a lot of reports on inflation over the last week is that it looks like it's starting to come down, and the Federal Reserve is starting to say that maybe they're not going to increase rates as much as they thought they would have to. And so we just had a 75 basis point rate increase this month, and the next one might only be 50 basis points. Again, that's what a lot of analysts are saying, but we'll just have to see what happens. But if the Federal Reserve starts to pull back, then again, they're pulling back, and then that means that we're going to hit peak rates, and then eventually we're going to have to come down from peak rates. But we'll just have to see what happens on that one. The next item that's going to have to come down is inflation, because although car prices increased with everything else increasing in value, which ultimately helped out the whole inflation situation in a bad way, now it's actually hurting cars, because as long as inflation stays high, buyer sentiment is really low, and so people just don't want to buy cars. And on top of that, they're having to spend more money on everyday items, so they have less money to spend on something like a car, and so inflation also has to come down. And again, this is another thing where it's kind of a guessing game. A lot of people think that, well, 2022 is going to be a really bad year. 2023 is probably going to be somewhat of a bad year. And then by 2024, inflation will be fixed and we'll kind of be in a normal market like what we were like before the pandemic. The next item is car repossessions. And until this figure starts to slow down, we're not going to see car values stop declining, because what's happening right now is the market is continually getting flooded with more and more supply from a lot of sources, but a big one right now is repossessions. And repos definitely help bring down car values more than any other category, not because of the numbers, but because of the condition that these cars are in. Because you got to remember, the average value of a car is going to be determined by the average car that is being transacted upon. And repos are typically in worse condition compared to regular vehicles. And so if you have more and more repos entering the market, well, average condition is going to continue to decline, which means that average values are also going to continue to decline. So until the repo issue starts to slow down, values will keep going down. Now, another item that isn't exactly an issue right now, but could become an issue next year is actually unemployment. We've seen a lot of layoffs in the tech industry over the last year, and this might start to trickle into other industries. And so if you have a really high unemployment rate, then that will negatively impact car values, because there's just simply less people that have the means to purchase a vehicle. And so this, like I said, isn't necessarily an issue yet, but it could become an issue next year. And so I want to take this into account when we decide when the market's going to bottom out. The last big item is new car manufacturing. This is actually somewhat propping up the market right now. Yes, the used car market is declining every single week, but it would be declining at a much more rapid rate if the new car market had a much better supply, but it doesn't. And so until the supply gets fixed with the new car market to where automakers are able to produce in the 16 to 17 million unit range per year rather than the 13 million unit range that we're tracking for right now, then we're not going to see a bottom, because again, even though there are most likely going to be a lot of people taken out of the market because of interest rates, job loss, and because of overall affordability because of inflation, well, if supply is low, supply is low, and so there's still going to be some level of pricing power. So at this point in the video, you can probably tell that, well, this is a very complex situation. It's not just one item that is bringing down the car market and going to determine the bottom. It's a bunch of different items and situations, both in the car world and outside of the car world as well. That being said, though, with the information that we have now and with the trends that we are seeing now, and all of the people that I've talked to within different automakers and then at different dealerships, here is my best guess as to when the car market is going to hit some sort of bottom before we start to see just normal depreciation curves with vehicles like what we saw prior to the pandemic. The bottom will most likely happen sometime in 2023 or potentially early 2024. And here's why. So first off, earlier in the video, I talked about how the Federal Reserve might start to slightly pull back on their rate increases. And so what that means is we're probably going to hit peak rates in the very near future. Again, that's still up in the air, but the trends are looking like that's what's going to happen. And then on top of that, right now, the jobs market is still actually pretty strong. It is starting to weaken a little bit. And like I said, we are starting to see layoffs in certain industries, but it doesn't look like we're going to see like a collapse in the jobs market where, a lot of people are going to be unemployed. Again, that is also still up in the air, but that's kind of the trend we're seeing over on that side. And with the car repos, well, if interest rates peak and then eventually start to come down, then what this means is that, if people have really high interest rate loans, then they'll have a chance to refinance with their car, as long as the values are in line to where they can actually refinance. Because if they're too upside down in their loan, then, well, that's not going to help out the repo issue. But what it could also do is help these people trade into a new vehicle at, a lower amount, because again, these values are going to decline by a large enough margin that they'll be able to pick up a car for cheaper. But again, on the flip side, their car will be worth a lot less. So it could be a situation where they're just screwed either way. But there is a chance that some of these people that are repos today potentially won't be repos in the future, and that the rate will slow down as those rate increases slow down, just to make affordability a little bit better. And then when it comes to new car manufacturing, what I'm hearing from most new car automakers is that they're expecting things to be relatively normal by the end of 2023. A really good example is General Motors. So if you look at the amount of vehicles they're producing in 2021, it was absolutely abysmal. But in 2022, they're actually up in terms of production with several months in this year, and it seems like things are only getting better. And a lot of other automakers are starting to experience that. Now, some automakers are experiencing the opposite, like Honda and Acura, where their production is decreasing day by day. But the general consensus with most automakers is they're probably going to have the problem mostly figured out by the end of 2023. And so that's why I say that that's probably when the bottom will happen for the car market, because that's it looks like that's when everything's kind of coming to a point where we're most likely going to see peak interest rates, then they'll start to decline. And again, the biggest thing is also that car production. So there's a lot that's happening, but it seems like it's all coming to a point at that date. That being said, should you really wait until the end of 2023 or the beginning of 2024 to purchase a car? And well, not exactly. When it comes to new cars, the prices are actually probably going to be even more at that point. New car automakers are pretty much like where they're at with pricing. Like, there is no plans of decreasing pricing. I know that sounds crazy because of how expensive new cars have gotten, but people are buying the new cars. Manufacturers have pricing power, and so there's not really any talk of rebates or any sort of like price declines anywhere in the near future. And so I wouldn't expect new cars to get any more affordable, but again, the interest rates could potentially get more affordable in the future. When it comes to the used car market, it's kind of like a catch-22 situation where if you have a trade-in, well, you're screwed either way, because if you wait until next year to buy a car and trade in your car, then, well, your trade-in is going to be worth less money, but the car you're buying is going to be less money. So it's the same as if you'd done it today, where your trade-in's worth more and the car you're buying is also more expensive. And so that's why you probably have heard a lot of these YouTubers say you should sell your car now and then wait to buy a car. And hey, if you have the option to do that, then that might be the best thing for you to do. But what I do want to say is that catching the bottom of the car market is actually not going to be all that difficult. And before I get into this next section, this is not financial advice whatsoever. I got to put that preface here. So when the stock market bottoms out, it's something that usually is pretty quick. It's like it will go to a certain range within one day, and then by the next day, right, it goes up, and then maybe it continues to go up for the next several years. With the car market, when it hits a bottom, it can be at that bottom for months and sometimes years, because, well, you can't just instantly turn around and sell a car like you can with a stock, right? With a car, it has to be reconditioned, and you've got, like, there's a lot that has to come into play for a car to be sold. The turnover rate is a lot longer than some other things that people will buy and sell. And so what that means is that when we hit the bottom, you're going to have time. You're going to have time to navigate the situation and, find the right car that makes the most amount of sense. But that being said, it might not be so obvious at the same time that we have hit the bottom, because what you're going to see is that car values are going to hit a certain rate, and some cars are going to experience, a normal amount of depreciation. And so you're just going to think, okay, this is just what the car market is, but you're not going to be like, oh, this is a bottom, because, well, car values are still going down. It's, again, always going to be a confusing situation to navigate. But if you look at what happened after the '08 financial crisis, car values declined by a massive amount. And so if you purchased certain cars between like 2010 and 2012, and you compared the values of those cars to before the pandemic, and especially after the pandemic, then the amount of money that those increased in value was just absolutely astronomical. And so again, there's probably going to be a similar situation. I don't know if it'll be as aggressive as what we saw in the '08 financial crisis, because, well, we have to get back down to normal car values first before we can get to what would be considered, cheap car values, to where you're buying a car for less than what that car is actually worth. So at this point, I know a lot of you might be confused, but just like a lot of other markets, guessing the bottom of the car market is, well, ultimately a guess. And so sometimes you might be right, and that'll be great. Sometimes you might be wrong, though, and you ultimately bought a car at the wrong time, and you're going to lose quite a bit of money. So the best piece of advice I can give you is just to be patient with the car market and become an expert in the vehicle you're planning on purchasing. Pay close attention to the values week to week and month to month. And if it happens to be a vehicle that's still being produced brand new, then also research the production and research when the production finally meets demand with that vehicle. So then you know that, well, a large portion of the buyer base that would have bought used because they couldn't get a new one can now get a new one, so they're not going to buy used anymore, which means the used values are ultimately going to tank, because people always want new over used if they can swing it financially. And so that will help you navigate this situation better. So just become an expert, be patient, and just like other markets, when there's peak fear, when nobody wants anything to have to do with cars, just like when nobody wants to have anything to do with stocks, that's probably the best time to buy. Again, not financial advice, but that's going to sum things up for today's video. If this helped you out at all, then I really appreciate it if you would subscribe, because, well, I post this content every single day. I'll see you.